If you are drawn to the allure of the market, aspiring to claim your fortune from its vast and ever-shifting currents, then you must first confront a truth more fundamental, more insidious, and ultimately more decisive than any chart pattern or economic report. The market is not merely an external arena, it is a relentless inner battlefield, where your own mind wages war against itself. The vast majority of those who venture here, even those armed with intellect and ambition, ultimately falter, their capital eroded and their dreams shattered, not primarily due to flawed methods, but due to the unseen psychological flaws inherent in human nature. This unforgiving crucible, this grand test of character, operates with chilling indifference to your hopes, your fears, or your personal desires. It perpetually tests your emotional fortitude, relentlessly probing for weakness, subtly exploiting every human tendency towards impatience, greed, hope, and ego. It is a master psychologist, designed to amplify your every internal flaw and to turn your most basic human emotions into powerful, destructive forces that guarantee your ultimate ruin. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. Initial successes, often born more of market serendipity than genuine insight, frequently serve as a prelude to a speculator's downfall. They breed a dangerous overconfidence, an illusion of infallibility that blinds one to the market's true power and one's own limitations. This hubris, a purely psychological failing, leaves one vulnerable to the subtle deceptions and brutal reversals that await those who mistake fleeting luck for enduring skill. Without first mastering oneself, without conquering the turbulent inner landscape of one's own emotions and impulses, all technical knowledge, all meticulously crafted strategies, and all profound understanding of economic fundamentals will ultimately prove futile. The market does not reward intellect alone. It rewards disciplined, objective execution, and such execution is impossible when the mind is a slave to its own uncontrolled passions. This arena is the ultimate test of human nature. It is here that the speculator's courage is weighed against their fear, their patience against their impulsiveness, and their humility against their pride. The true victories in speculation are not merely monetary, they are psychological triumphs, achieved by those who have waged and won the internal war against their own predispositions and weaknesses. The competitive landscape of the market ensures that any psychological vulnerability becomes an immediate liability. The smart money, the disciplined few, operate with cold, calculating detachment, ready to capitalize on the predictable emotional errors of the masses. Thus, the mind of the speculator becomes the ultimate competitive arena, where the battle for financial supremacy is first and foremost a battle for self-mastery. The external conditions of the market, whether it trends up or down, whether it is calm or volatile, are far less significant than the internal reactions they provoke within the speculator. The market does not care for your personal biases or your emotional states, it merely presents opportunities and risks. Your response to these, dictated by your psychological fortitude, is what truly determines your fate. This inherent indifference of the market to human emotion renders emotions not merely unhelpful, but actively detrimental. Hope keeps you clinging to losing positions, fear paralyzes you from acting on clear signals, greed compels you to overtrade or take excessive risks. These are not tools to be wielded, but internal enemies to be ruthlessly suppressed for the sake of survival and profit. True market mastery, therefore, begins with a profound journey of self-awareness. It involves meticulously identifying one's own psychological weaknesses, confronting them with unflinching honesty, and systematically dismantling their power over one's decision-making process. This path to mastery is forged in the crucible of personal experience, often through the bitter tuition of costly errors. Every significant loss I incurred, every devastating setback that threatened to annihilate my career, almost invariably stemmed from a psychological failing, an emotional lapse, rather than a miscalculation of facts or a flaw in my method. The market, in its unyielding wisdom, ruthlessly punished every deviation from strict discipline, forcing me to confront and conquer my own human nature. The journey to building enduring wealth in the market, to transforming from a mere gambler to a professional speculator, is fundamentally a psychological one. It begins with a profound understanding that the external market is merely a reflection of the internal war waged within every participant. To win the external battle, one must first win the internal one. This video will peel back the layers of this inner conflict, delving into the specific psychological pitfalls that lie in wait for every speculator, ready to sabotage even the most brilliant strategies. Prepare to confront the unseen enemies within your own mind, for only by recognizing and conquering these psychological traps can you hope to survive and ultimately thrive in the relentless arena of the market. Many aspiring speculators dedicate countless hours to meticulously studying market principles, devouring books on trend following, capital preservation, and risk management. They diligently absorb rules for entry, exit, and position sizing, believing that intellectual understanding alone is sufficient for success. Yet, I assure you, from the depths of my own hard-won experience, that while sound principles are absolutely essential, they are, in themselves, utterly insufficient. They are merely the blueprint. The execution depends on a variable far more volatile and unpredictable, the human equation. A perfectly designed trading system, an impeccable set of rules, or a brilliant analytical method, will inevitably break down when confronted with the raw, untamed forces of human emotion. Fear, greed, hope, impatience, stubbornness, and overconfidence, these are not mere abstract concepts, they are powerful, visceral impulses that, left unchecked, will invariably override logic, corrupt judgment, and compel actions that directly violate even the most carefully constructed principles. There exists a profound and tragically common disconnect between what a speculator intellectually knows they should do, and what they actually do when placed under the immense pressure of real-time market fluctuations, when their capital is on the line. The disciplined adherence to a stop-loss, the patience to wait for a confirmed signal, the humility to cut a loss, these are simple intellectual concepts, yet their execution demands an emotional fortitude that few truly possess. The market, in its chilling efficiency, is a master exploiter of this very disconnect. It masterfully sets psychological traps, luring traders into predictable errors by amplifying their inherent human predispositions. It plays upon hope to keep them in losing positions, upon fear to force them out of winning ones prematurely, and upon greed to tempt them into overtrading or risking beyond all reason. These are not random occurrences, they are meticulously designed tests of emotional discipline. Consider a well-built ship, engineered with precision, equipped with the finest charts and a meticulously planned course. Yet, if its captain is undisciplined, prone to panic in a storm, or driven by irrational impulses, that ship, despite its perfection, will inevitably veer off course and ultimately wreck. So it is with the speculator. Principles are the ship and the chart, emotional control is the steady hand of the captain. Trading, at its very core, is not merely an exercise in mathematics or economic forecasting, it is an inherently psychological endeavor, a relentless test of character under immense duress. The external fluctuations of price are merely a reflection of this deeper, more fundamental struggle occurring within the mind of every participant. The ultimate competitive advantage is gained not by superior information, but by superior emotional control. The internal struggle is a constant, relentless, and often unseen battle, fought in solitude. It is the persistent war against oneself, against the very human tendencies that lead to predictable errors and consistent losses. To achieve true mastery, one must recognize that this inner conflict is as real, as demanding, and as crucial as any external analysis of market conditions. The pursuit of consistent success in the market demands a profound fusion of intellectual understanding and an iron will. Principles must not merely be known, they must be internalized, disciplined, and executed with an unyielding commitment that transcends transient emotional states. It is the seamless, almost automatic, execution of objective truth, uncorrupted by subjective human flaws, that marks the path to enduring profitability. This video will meticulously delve into the specific human flaws, the insidious psychological traps that lie in wait for every speculator, ready to sabotage even the most brilliant analytical strategies. We will dissect how these internal weaknesses manifest in real trading scenarios and lead to ruin. Understanding this human equation is paramount, for it determines not just who survives the market's brutal tests, but who ultimately thrives within its unforgiving currents. To become a master speculator, you must first become a master of yourself, capable of wielding principles with unwavering emotional fortitude. This internal victory is the true precursor to all external financial triumph. Prepare to confront the uncomfortable truths about your own predispositions, for only by recognizing and systematically dismantling these inherent human flaws can you hope to unlock your full potential and navigate the market with enduring success. This is the ultimate lesson, purchased at immense cost, yet freely offered to those who possess the wisdom to listen. Among the treacherous currents that conspire to wreck the speculator's vessel, none is more insidious, more cunning, or ultimately more destructive than blind hope. It is the whispered delusion that, against all objective evidence, a losing position must eventually turn around, that the market owes you a recovery, or that your initial flawed judgment will somehow be vindicated. This is the most profound seduction of loss, leading countless ambitious individuals down the path to utter ruin. Hope, in its purest form, has no place in the objective calculus of the market. The market, in its chilling indifference, cares nothing for your aspirations or your personal desires. It responds solely to the unfeeling interplay of supply and demand, to the precise balance of buying and selling pressure. When a position moves against you, when the market unequivocally declares your initial judgment wrong, clinging to hope is an act of intellectual and financial suicide. The ego plays a cruel hand in this deception. The refusal to admit being wrong, the desperate need to prove one's initial brilliance, compels the speculator to cling to a losing trade. Pride whispers that to cut a loss is to acknowledge defeat, to admit a flaw in one's judgment. This hubris blinds one to the glaring reality of mounting losses, transforming what should have been a minor, manageable setback into a sprawling financial catastrophe. This blind hope invariably leads to the deadliest of all traps, averaging down. The speculator, consumed by the delusion of getting a bargain, adds more capital to a losing position, convinced that by lowering their average cost, they will inevitably break even or profit when the inevitable recovery occurs. This is not strategy. It is a desperate act of pouring good money after bad, doubling down on a mistake that the market has already unequivocally condemned. The psychological torment of watching losses mount while paralyzed by blind hope is a torment I know intimately. The internal battle between the desperate longing for a rebound and the crushing reality of the ever-declining price creates an unbearable tension. This mental anguish drains focus, erodes confidence, and leaves the speculator emotionally exhausted, incapable of making rational decisions when clarity is most needed. Blind hope acts as a veil, obscuring the objective market signals that scream exit. It renders facts irrelevant, transforming clear warnings into mere temporary setbacks. The market may provide every indication that a stock is fundamentally weak, that its line of least resistance is downwards, yet the speculator, ensnared by the siren song of hope, remains deaf and blind to its unvarnished truth. The market, in its unyielding wisdom, does not negotiate with hope. It does not respond to prayers or desperate wishes. It responds solely to the actions of buyers and sellers, to the shifting balance of power on the tape. To believe that hope alone can turn a losing position into a winner is to fundamentally misunderstand the impersonal, logical, and often brutal mechanics of the financial arena. Contrast this destructive hope with the disciplined realism of the professional speculator. He operates not on emotion, but on probabilities and predefined rules. When a position moves against him, his only hope is that his initial loss will be small, and his only action is to cut it swiftly and without hesitation, preserving capital for the next, more promising, opportunity confirmed by the market. The cost of succumbing to blind hope is immeasurable. Small, manageable losses, which are the inevitable tuition fees in this demanding school, are allowed to balloon into catastrophic, account-annihilating defeats. Capital, painstakingly accumulated, vanishes in a relentless downward spiral, leaving behind only regret and the bitter realization of a profound self-betrayal. Moreover, hope does not just consume financial capital, it devours mental capital. The constant emotional drain of clinging to a losing position exhausts the mind, draining focus, impairing judgment, and leaving the speculator emotionally crippled for future opportunities. The ability to think clearly, to act decisively, is systematically eroded by the continuous internal battle against reality. The ultimate betrayal of blind hope is that it often keeps the speculator in the game just long enough to be completely wiped out. It fosters a false sense of security, delaying the inevitable until there is nothing left to lose. The market, with its cold indifference, does not discriminate. It will relentlessly punish those who bring hope to a game that demands objective reality and unwavering discipline. Therefore, the first and most critical lesson for any speculator, honed in the crucible of my own painful defeats, is this: when you place a trade, eliminate hope. When the market turns against you, cut your losses, preserve your capital, and let hope perish along with the ill-fated position. This is not pessimism, it is the brutal truth of survival, the first step towards building an unshakable foundation for enduring success. If blind hope is the insidious seducer that compels you to cling to ruin, then paralyzing fear is its equally destructive counterpart, the insidious force that cripples action, distorts judgment, and ensures missed opportunities and compounded losses. It is the tyranny of doubt, a pervasive psychological grip that can render even the most brilliant analytical mind utterly impotent in the face of the market's relentless movements. One of fear's most common manifestations is the fear of missing out, FOMO. This gnawing anxiety compels speculators to abandon their discipline, to rush into trades without proper confirmation, to chase surging prices or fleeting opportunities, long after the rational entry point is passed. This impulse, driven by the terror of being left behind, invariably leads to impulsive, ill-timed entries, leaving the speculator vulnerable to swift reversals and immediate losses as the smart money takes its profits. Conversely, fear can manifest as the fear of taking a loss. This fundamental aversion to admitting error, this reluctance to realize a numerical deficit, causes speculators to procrastinate in cutting losing positions. The small, manageable tuition fee of a quick loss is allowed to fester, transforming into a large, debilitating financial wound, simply because the speculator is paralyzed by the unpleasantness of accepting a negative outcome. The pervasive fear of being wrong is another insidious aspect. This crippling psychological burden prevents speculators from acknowledging mistakes, from learning from their errors, and from adapting their approach. Instead of dispassionately analyzing a losing trade for its lessons, they seek to justify it, to rationalize its continued existence, trapping themselves in a cycle of denial that guarantees repeated failures and deepening losses. This pervasive fear can also lead to complete paralysis, a chilling state where even when clear, undeniable market signals emerge, the speculator remains frozen, unable to act decisively. The potential for profit is clear. The path of least resistance is established, yet the terror of committing, of risking, of potentially being wrong, renders them utterly impotent, watching as opportunities unfold without their participation. Fear is not only destructive in losses but also sabotages profits. The fear of losing profits drives speculators to exit winning positions prematurely, snatching a few meager gains, only to watch in agony as the stock continues its powerful upward trajectory, leaving vast sums of potential profit on the table. This impulse prioritizes immediate, limited gratification over disciplined, long-term trend following. This pervasive fear systematically distorts perception, transforming clear, objective market signals into a bewildering cacophony of confusing noise. The mind, clouded by anxiety, loses its ability to interpret data accurately, to discern genuine trends from mere fluctuations, or to trust its own observations. Judgment becomes impaired, and decision-making devolves into a series of panicked reactions driven by irrational impulses rather than cold logic. The physiological impact of chronic fear in trading is profound. The constant stress and anxiety erode mental clarity, impair cognitive function, and lead to physical exhaustion. This sustained state of duress systematically undermines a speculator's ability to think critically, to maintain discipline, and to execute their strategies flawlessly, reducing them to a state of reactive, emotional vulnerability. Fear is also highly contagious, spreading rapidly among the masses and amplifying market panics. It drives indiscriminate selling, pushing prices far below any rational valuation, as individuals succumb to collective hysteria. The disciplined speculator, however, must recognize these fear-driven climaxes as powerful, often profitable, opportunities to act against the herd, but only if they are immune to the contagion of doubt. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. Contrast this destructive fear with the disciplined caution of the professional speculator. He approaches the market with respect, not terror. He understands that risk is inherent, but he manages it with calculated precision, through predefined rules and unwavering emotional control. He acknowledges fear, but he never allows it to dictate his actions or override his objective analysis. The cost of succumbing to paralyzing fear is immeasurable. Countless missed opportunities, compounded losses due to delayed action, and a shattered confidence that makes future success seem impossible. It traps the speculator in a cycle of regret and self-recrimination, ensuring that the market's potential for profit remains forever out of reach, overshadowed by the tyranny of doubt. Therefore, recognize fear as a formidable internal adversary. It will relentlessly test your resolve. But by cultivating absolute discipline, by adhering to your rules without exception, and by developing an objective detachment from outcomes, you can transform this destructive emotion into healthy caution, ensuring that fear compels prudent action, never paralysis or irrational impulsivity. Among the most powerful, the most seductive, and ultimately the most devastating psychological traps that lie in wait for the speculator is unchecked greed. It often appears subtly, frequently after a period of success, whispering promises of even greater riches, luring the unwary into abandoning their discipline in the relentless pursuit of just a little bit more. This insatiable hunger for excess, this relentless drive to squeeze every last dollar from the market, invariably leads to ruin, leaving the speculator with far less than they might have achieved with disciplined restraint. Greed compels the speculator to take excessive risks, to commit disproportionately large sums of capital to single positions, or to leverage their funds beyond all reason. The allure of amplified gains blinds one to the exponential increase in potential losses. The pursuit of easy money clouds judgment, pushing individuals to gamble with their entire capital in a desperate attempt to accelerate their fortune, fundamentally misunderstanding the methodical and patient nature of true wealth accumulation in the market. This unchecked hunger also manifests as a powerful temptation to overtrade, a relentless compulsion for constant activity, even when no clear or confirmed opportunities exist. Driven by the insatiable desire for more profits, the speculator engages in frantic, ill-considered transactions, trading for the mere sake of action rather than for profit. This overtrading consumes capital through commissions, generates unnecessary losses from poor entries, and drains mental energy, leaving one exhausted and devoid of genuine strategic insight. One of greed's most common and tragic manifestations is the refusal to exit winning positions, constantly hoping for the last dollar. The speculator, having ridden a profitable trend, becomes emotionally attached to their gains, convinced that the upward movement will continue indefinitely. They ignore clear market signals of exhaustion or reversal, driven by the desire to extract every possible cent. This hubris inevitably leads to watching substantial paper profits vanish, as the market turns against them, often forcing an exit at a far less favorable price, or even at a loss. Greed fosters a dangerous illusion of quick riches, blinding the speculator to the methodical, patient, and often slow nature of true wealth building in the market. It distorts the perception of time and risk, replacing a disciplined, long-term approach with a desperate sprint for immediate, massive returns. This impatience with measured growth systematically undermines the very principles that ensure consistent profitability, leading to impulsive, irrational decisions. Greed also profoundly distorts judgment, turning rational analysis into mere wishful thinking. Objective market signals are reinterpreted through the lens of avarice. Warnings are dismissed as temporary aberrations. The speculator, driven by the relentless pursuit of more, sees only what they want to see, rather than the unvarnished truth displayed on the tape, leading to a profound disconnection from reality and guaranteeing future missteps. The psychological cycle driven by unchecked greed is insidious. Initial wins, often modest, fuel an intoxicating sense of infallibility and an insatiable appetite for greater gains. This inflated ego, coupled with a belief in one's own genius, leads to increasingly reckless behavior, until the inevitable market reversal delivers a devastating blow, often resulting in a complete blow-up of the trading account, wiping out years of patient accumulation. Greed's inherent impatience directly conflicts with the market's own natural rhythm. The market moves in waves, in cycles of accumulation, advance, distribution, and decline. Greed, however, demands constant, aggressive upward movement, pushing the speculator to force trades in stagnant markets, to enter near tops, and to chase prices that have already run their course, fundamentally misaligning with the market's true, underlying flow. The cost of succumbing to unchecked greed is profound. It leads to the rapid erosion of painstakingly accumulated capital, as reckless risks and impulsive decisions decimate accounts. It prevents the speculator from engaging in the patient, methodical long game that truly builds enduring wealth, instead trapping them in a cycle of dramatic peaks followed by catastrophic valleys, shattering their discipline and their confidence. Beyond the monetary cost, greed systematically drains mental capital. The constant emotional demand of chasing every opportunity, the anxiety of pushing for more, and the distress of watching profits disappear, leave the speculator exhausted and emotionally brittle. This mental fatigue impairs judgment, making it impossible to apply sound principles, ensuring a downward spiral of increasing errors and mounting losses. Greed is a relentless and unquenchable thirst. It is never satisfied, always demands more, and consistently pushes the boundaries of prudence. It whispers that enough is never enough, tempting the speculator to violate their own risk limits, to ignore diversification, and to abandon all sense of caution in the pursuit of an elusive, ever greater fortune, ensuring they eventually overreach and inevitably face severe consequences. Ultimately, greed's relentless pursuit of everything invariably leaves the speculator with nothing. It is a powerful, internal enemy that must be recognized, understood, and ruthlessly controlled. For in the unforgiving arena of the market, the discipline of knowing when to say enough and when to walk away from a profitable position is the ultimate safeguard against ruin and the true precursor to building lasting, sustained wealth. If unchecked greed compels the pursuit of excess, then destructive impatience is its insidious accomplice, a psychological trap that consistently leads to premature action, missed opportunities, and profound regret. It is the overwhelming urge to constantly do something, to force the market to conform to one's own timeline, rather than possessing the iron discipline to wait for clarity and for the opportune moment to present itself unequivocally. This costly haste invariably sabotages even the most well-intentioned strategies. Impatience prevents the speculator from waiting for clear signals, for confirmed setups, for the moment when the market unequivocally declares its intention. The market moves in waves, in cycles of accumulation, advance, distribution, and decline. True profits are made by aligning with these larger movements, not by attempting to snatch every small fluctuation. Impatience, however, compels constant activity, driven by a restless energy that cannot tolerate periods of strategic inaction. The urge to constantly be in the market is a pervasive manifestation of impatience, often driven by boredom or the paralyzing fear of missing out, FOMO. The speculator, unable to tolerate idleness, places trades out of a desperate need for activity, even when no discernible opportunity exists. This leads to impulsive, ill-timed entries, generating unnecessary commissions and exposing capital to random market noise, rather than profitable trends. This destructive haste frequently leads to rushing entries, committing capital before thorough due diligence has been completed, before all confirmation signals have aligned, or before the market has clearly established its path of least resistance. Such impulsive entries often place the speculator on the wrong side of a minor fluctuation or a false move, leading to immediate losses and significant mental strain, as the position struggles to find its footing. The profound cost of being early, of acting out of impatience, is multifaceted. It involves tying up valuable capital in non-performing or losing positions, suffering whipsaws that erode confidence and deplete funds, and experiencing the psychological torment of watching a position move against you, simply because you lack the discipline to wait for the optimal moment. Patience, in speculation, is a form of active capital preservation, protecting resources for genuine opportunities. Impatience does not only affect entries, it also sabotages exits. It can lead to cutting winners too soon, snatching small profits while leaving vast sums on the table, simply because the speculator lacks the patience to ride a powerful trend to its logical conclusion. Conversely, a lack of patience with pain can paradoxically cause a speculator to hold losers too long, delaying the necessary cut because they are unwilling to tolerate the immediate discomfort of realizing a loss, hoping it will recover. The psychological pressure of waiting, of tolerating strategic inaction during periods of market indecision, is immense. It is a constant struggle against one's own restless mind, against the societal conditioning that equates activity with progress. Yet, this internal discipline is paramount. The speculator must cultivate the fortitude to sit idly by, observing the market with a detached, almost scientific patience, until the precise moment for action is delivered by the market itself. Impatience inevitably leads to overtrading, the compulsive desire to make constant transactions, even when the market offers no clear edge. This activity is driven by a restless need for stimulation, rather than by objective opportunity. Overtrading consumes capital through commissions and spreads, generates unnecessary losses from poorly conceived entries, and rapidly depletes the mental and emotional reserves required for disciplined speculation. Moreover, impatience profoundly disregards the market's own natural rhythm and its inherent cycles of accumulation, advance, distribution, and decline. It attempts to force profits where none exist, to extract gains from periods of consolidation, or to predict reversals before they have clearly manifested. This fundamental misalignment with the market's natural flow ensures that the speculator is perpetually off sides, battling against the dominant forces rather than flowing with them. The consequence of destructive impatience is a relentless cycle of frustration and loss. The speculator is constantly reacting to events rather than anticipating them, forever chasing the market, often entering near the end of a move or getting caught in abrupt reversals. Missed opportunities, unnecessary losses, and a profound erosion of confidence become the defining characteristics of their trading journey. Patience is not merely a virtue in speculation. It is an active, vital discipline, a cornerstone of successful trading. It is the ability to wait for clarity, to allow the market to confirm its intentions, and to act only when the probabilities are overwhelmingly in your favor. This discipline ensures that your capital is deployed with maximum efficiency and minimal risk, preserving it for the truly significant opportunities. Ultimately, haste makes waste in the unforgiving arena of the market. Destructive impatience guarantees that fortunes are squandered through impulsive, ill-timed actions. The disciplined speculator, however, understands that patient observation, strategic inaction, and waiting for the undeniable moment are the true precursors to capturing monumental profits, ensuring their actions are always aligned with the market's precise and deliberate unfolding. Among the most devastating psychological traps that ensnare speculators, leading to relentless losses and ultimate ruin, is crippling stubbornness, a pervasive refusal to admit error, particularly when one's initial judgment has been proven wrong by the market. This deeply ingrained human tendency, fueled by ego and pride, compels the speculator to cling desperately to a losing opinion, even when objective market signals unequivocally declare its invalidity. It is a futile battle against an impartial, all-powerful force, a struggle that guarantees defeat. The illusion of being right, of having superior foresight or insight, can be an intoxicating and ultimately destructive force in the market. The speculator, having committed to a position based on a personal conviction, becomes emotionally invested in that conviction's veracity, rather than the cold, hard reality of price action. Pride whispers that to cut a loss is to acknowledge intellectual defeat, to admit a flaw in one's infallible judgment. This hubris blinds one to the glaring reality of mounting capital erosion, transforming what should have been a minor, manageable setback into a sprawling, account-annihilating financial catastrophe. This psychological rigidity prevents the speculator from embracing the fluidity and constant evolution of the market. The market cares nothing for your past successes, your current opinions, or your personal desires. It moves according to its own immutable laws, dictated by the relentless interplay of supply and demand. To attempt to force the market to conform to one's preconceived notions, to stubbornly hold on to a position that defies its clear signals, is an act of supreme arrogance that the market will relentlessly punish. Stubbornness manifests tragically in the speculator's inability to cut losses swiftly and decisively. Instead of acknowledging a mistake and preserving capital, the stubborn individual remains paralyzed, watching as their position deteriorates, hoping for an improbable recovery that rarely materializes. This delay is fatal. A small loss, if not cut immediately, metastasizes into a large one, draining both financial resources and mental fortitude, leaving the speculator emotionally crippled and financially vulnerable. This psychological rigidity also leads to a catastrophic blindness to the market's confirming signals for reversals, whether upward or downward. A stock might clearly break below a critical support level, signaling a profound shift in trend, yet the stubborn speculator, clinging to their long position, dismisses it as a temporary fluctuation. Conversely, a stock might fail to make new highs on confirming volume, yet the short seller remains committed, unable to admit the bull's resurgence. The psychological cost of crippling stubbornness is immense and insidious. It breeds chronic stress, overwhelming frustration, and profound mental exhaustion, as the speculator wages a losing battle against an unyielding reality. This sustained state of duress impairs judgment, erodes confidence, and leads to impaired decision-making, ensuring a continuous cycle of errors and mounting losses, ultimately pushing the individual towards isolation and despair. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. Admitting error in the market is not a sign of weakness. It is the ultimate testament to a speculator's strength, humility, and intellectual honesty. It requires the courage to set aside ego, to objectively confront one's mistakes, and to pivot decisively when the market proves a thesis wrong. This capacity for quick self-correction is a defining characteristic of professional speculators, ensuring they remain fluid and adaptable in a constantly changing environment. The market, in its profound indifference, will relentlessly humble all who attempt to fight its truth. It demands humility, flexibility, and a dispassionate respect for its supreme authority. Those who cling to their opinions, rather than submitting to the market's facts, are destined to experience its brutal lessons repeatedly, as their stubbornness leads them deeper into financial and psychological ruin. The consequence of crippling stubbornness is devastating. It guarantees the compounding of losses, as capital is continuously committed to a flawed idea. It blinds the speculator to new, emerging opportunities, as their resources remain tied up in decaying positions. And it systematically consumes mental capital, leaving the individual emotionally drained and intellectually fatigued, unable to recognize or act upon genuine signals. This psychological trap often creates a vicious cycle. Initial stubbornness leads to significant losses, which in turn reinforce the desperate need to be right next time, compelling even greater rigidity and an intensified refusal to admit future errors. This self-defeating loop perpetuates the very behavior that leads to ruin, trapping the speculator in a prison of their own making, where ego triumphs over logic. Therefore, the discipline of humility, the willingness to acknowledge mistakes swiftly, and the flexibility to adapt to the market's undeniable truth are paramount for survival and enduring success. The market does not reward stubbornness, it rewards intellectual honesty and a ruthless commitment to reality. Only by embracing this truth can the speculator hope to navigate its treacherous currents. Ultimately, crippling stubbornness ensures that the market's bitter tuition is paid not in small, manageable installments, but in catastrophic, career-ending bankruptcies. It transforms a potentially temporary setback into an absolute, irreversible disaster, leaving the speculator with nothing but the bitter ashes of misplaced pride and the profound regret of having fought a battle that could never be won. Among the most seductive and persistently alluring psychological traps that lie in wait for the unwary speculator is the temptation of tips and outside, unverified information. The promise of easy money, of a shortcut to riches revealed by someone with inside knowledge, is an almost irresistible siren call. Yet, I tell you, from a lifetime spent navigating the market's treacherous currents, that relying on such hearsay is a direct path to profound disappointment, consistent losses, and the ultimate destruction of your capital. The allure of tips fundamentally undermines the very foundation of independent judgment and objective observation, which are the absolute prerequisites for genuine success in speculation. Instead of meticulously studying the market's own actions, of dissecting price and volume, the speculator places their trust in the unverified words of others. This outsourcing of critical thinking inevitably leads to blind gambling, as decisions are made without personal conviction or a clear understanding of the underlying forces at play. The source of these tips is often dubious at best, and malicious at worst. They may originate from genuinely uninformed individuals who mistake luck for insight, from biased parties with their own hidden agendas, such as those promoting their own positions, or from outright charlatans seeking to profit from the credulity of others. In my early days in the bucket shops, these tips were often manufactured precisely to lure unsuspecting gamblers into traps, designed to capitalize on their hopes and their ignorance. Furthermore, by the time a hot tip reaches the average speculator, it is almost invariably too late. The truly informed money, the large operators who move millions, have already acted on their superior intelligence. The opportunity, if it ever genuinely existed, has been exploited, and the smart money is likely already looking to liquidate their positions precisely into the buying frenzy created by the very tips that have now reached the public domain. To act on such belated information is to be perpetually relegated to chasing the market, forever a step behind. Relying on tips fosters a profound and detrimental dependency. It prevents the speculator from engaging in the arduous but necessary process of genuine market education, of cultivating their own observational skills, and of developing a personal, verifiable system based on objective facts. This reliance ensures a perpetual state of intellectual helplessness, where one's financial fate is placed entirely in the hands of others, rather than being forged through one's own hard-won understanding. Perversely, there can be a subtle psychological relief in accepting tips. It allows the speculator to shift responsibility for their losses. If a trade based on a tip goes wrong, the blame can be conveniently attributed to the tipster, rather than to one's own flawed judgment or lack of discipline. This avoidance of personal accountability prevents genuine learning, ensuring that the cycle of relying on others and suffering losses continues unabated, perpetuating a state of perpetual financial vulnerability. The market, I assure you, speaks its own truth, clearly and consistently, through its own actions, through the objective interplay of price and volume, through the precise movements of the tape. It does not communicate through whispers, rumors, or the excited pronouncements of so-called insiders. Those who fail to learn its direct, unvarnished language are perpetually deaf to its true signals and forever susceptible to the deceptive noise of external chatter. Even what may appear to be genuine inside information is, in fact, worthless without meticulous market confirmation. A rumor of a pending merger or a new discovery, however credible it may sound, is merely speculation until the market itself, through its price and volume behavior, unequivocally validates the claim. To act on such unverified information is to gamble blindly, risking capital on a premise that has not been subjected to the ultimate, impartial test of market action. The inherent danger of acting on unverified information is immense. It forces speculators into high-risk, low-probability trades, where the potential for significant loss far outweighs any speculative gain. Without the objective confirmation of the market, every tip is merely a coin toss, but one where the odds are systematically stacked against the uninformed participant, guaranteeing consistent capital erosion. The cost of succumbing to the temptation of tips is profound. It leads to a pattern of consistent losses, as opportunities are chased too late and capital is committed on flawed premises. It prevents the development of a personal trading system, a disciplined approach based on verifiable facts, and it systematically shatters confidence, ensuring a perpetual state of financial and psychological fragility, where the speculator is always reacting, never anticipating. True freedom in speculation comes from cultivating an absolute independence of thought and action. It requires the courage to trust one's own objective observations, to develop one's own market convictions, and to act solely on the undeniable evidence presented by the tape. This self-reliance is the ultimate competitive advantage, ensuring that profits are earned through genuine understanding, not through the capricious whims of external noise. Ultimately, true profits in the market come from self-reliant observation, meticulous analysis, and disciplined execution, never from external noise or the seductive promises of unverified tips. The market is a brutally honest teacher. It rewards those who learn its lessons directly, not those who seek shortcuts through the unreliable whispers of others. To ignore this truth is to walk a predetermined path to ruin. Among the most pervasive and self-inflicted psychological traps that silently bleed a speculator's capital dry is the addiction of activity, or overtrading. This insidious compulsion is driven not by genuine market opportunity, but by an insatiable need for constant action, for the thrill of being perpetually in the game, regardless of whether the conditions are favorable. It is a profound misunderstanding of the market's true nature, mistaking incessant motion for profitable progress. This addiction is often fueled by boredom during periods of market indecision, or by the gnawing fear of missing out, FOMO, on what appears to be a rapid move. The speculator, unable to tolerate strategic inaction, succumbs to the restless urge to place trades, even when no clear signals are present, or when their own system dictates patience. This psychological discomfort with idleness compels them into continuous, often ill-conceived, transactions. The insidious illusion of productivity that overtrading fosters is profoundly misleading. Many mistakenly equate frequent trading with diligent effort, believing that the more transactions they execute, the greater their chances of accumulating wealth. Yet, the market cares nothing for your activity. It rewards intelligent anticipation, disciplined patience, and the precision of well-timed, strategically executed moves. Trading frequently does not, in itself, equate to profitable trading. More often, it guarantees its opposite. Overtrading systematically consumes precious capital through excessive commissions, spreads, and the compounding effect of minor, avoidable losses. Each unnecessary transaction, each foray into uncharted or unconfirmed territory, chips away at the trading account, even if the individual losses are small. This constant bleed, often underestimated, can rapidly deplete funds, leaving insufficient capital for truly significant opportunities when they finally emerge. Beyond the financial cost, overtrading exacts a devastating psychological toll. The relentless pressure of constant decision-making, the continuous swings between hope and fear with every new position, and the sheer volume of information processing lead to severe mental fatigue and burnout. This profound exhaustion impairs judgment, erodes concentration, and makes disciplined adherence to one's rules virtually impossible, trapping the speculator in a downward spiral of increasing errors. Overtrading profoundly disregards the market's own inherent rhythm and its natural cycles. The market moves in distinct phases: periods of quiet accumulation, powerful trends, volatile distribution, and indecisive consolidation. True profits are made by identifying and aligning with these larger movements. Overtrading, however, attempts to force profits during stagnant periods, to scalp fractions of points, or to predict reversals before they are confirmed, fundamentally misaligning with the market's deliberate flow. The immediate consequence of overtrading is a relentless cycle of frustrating whipsaws, where the speculator is constantly caught on the wrong side of minor fluctuations, suffering small losses that rapidly compound. Their capital is perpetually exposed to random market noise, distracting them from the big, decisive moves that generate real wealth. The market does not reward constant engagement, it rewards strategic detachment and precise timing. This psychological trap often stems from a deeper misunderstanding of the market's true nature, treating it as a source of entertainment or excitement, rather than a demanding intellectual pursuit. The thrill of constant action, the dopamine rush of being in the game, supplants the cold, calculating pursuit of profit. This gambling mentality transforms speculation into a costly hobby, ensuring that financial success remains an elusive illusion. Overtrading also systematically prevents the development of true market wisdom and disciplined observation. The speculator's mind is too preoccupied with constant activity to engage in patient waiting, meticulous analysis, or the calm discernment of subtle signals. It fosters a reactive mindset, where every move is an immediate impulse, rather than a deliberate, well-considered execution based on a clear opportunity. Perhaps one of the most insidious aspects of overtrading is the trap of attempting to make up losses by trading even more. After a setback, the desperate urge to quickly recoup lost capital compels even greater activity, leading to increasingly reckless decisions and deeper financial holes. This vicious cycle, fueled by desperation and a lack of patience, often pushes the speculator past the point of no return, annihilating their remaining funds. The true cost of the addiction of activity is multifaceted. It leads to the rapid and systemic loss of capital, a complete erosion of disciplined habits, and a profound imbalance in one's emotional and mental state. It ensures that the speculator remains perpetually reactive, perpetually exhausted, and perpetually frustrated, never truly breaking free from the self-defeating cycle of constant, unprofitable motion. Ultimately, genuine profit in the market comes not from incessant activity, but from strategic inaction, immense patience, and decisive action taken only when the market unequivocally presents a clear, high-probability opportunity. Overtrading is the path to ruin. Disciplined waiting and selective engagement are the true precursors to building lasting, formidable wealth. Among the most seductive and ultimately devastating psychological traps that ensnare speculators is the illusion of certainty, the dangerous belief that one unequivocally knows what the market will do next. This pervasive overconfidence, often born from a string of early successes or a superficial understanding of market mechanics, blinds the individual to the market's inherent unpredictability and its absolute indifference to personal conviction. This hubris guarantees a painful and costly humbling. Early wins, particularly those easily gained, can breed an intoxicating sense of infallibility. The speculator begins to believe in their own predictive genius, fostering a dangerous arrogance that overshadows the diligent study and disciplined caution essential for long-term success. This inflated ego compels them to ignore fundamental rules of risk management, to disregard objective market signals, and to chase ever larger returns based on a flawed belief in their own infallible foresight. The market, I assure you, cares nothing for your predictions. It does not reward prophecy, it rewards objective observation, disciplined reaction, and unwavering adherence to principles forged in its brutal reality. To believe that you can definitively know what the market will do next is to fundamentally misunderstand its complex, dynamic, and often irrational nature, setting yourself up for an inevitable and devastating confrontation with its supreme authority. This illusion of certainty often manifests in the compulsive pursuit of perfectly timing market tops and bottoms. The speculator, convinced they can call the precise reversal point, attempts to enter at the absolute peak of a decline or the exact trough of a rally. This endeavor is almost invariably futile, leading to costly losses as they are repeatedly caught in false moves or premature entries, proving the market's contempt for such arrogance. The dangerous belief in one's infallible foresight invariably leads to oversized positions and a catastrophic neglect of risk management. Convinced that their prediction is infallible, the speculator commits excessive capital, uses disproportionate leverage, and often fails to set or honor protective stop-losses. This reckless abandon, fueled by the illusion of certainty, exposes their entire capital to catastrophic risk, guaranteeing immense losses when the market inevitably moves against their fixed conviction. This psychological rigidity prevents the speculator from adapting to the market's undeniable truth. When the market, in its wisdom, moves contrary to their fixed prediction, the individual is unable to pivot, unable to admit error, and unable to adjust their strategy. They cling to their certainty, fighting the market's reality, watching as their capital evaporates, simply because their ego cannot tolerate being wrong. The ultimate cost of this illusion is not just monetary, it is the systematic destruction of intellectual honesty. The pursuit of being right, rather than being profitable, consumes the speculator. Each loss stemming from a failed prediction further entrenches the need to prove one's certainty, creating a vicious cycle of self-deception and mounting financial ruin, ensuring that ego triumphs over capital. This dangerous belief systematically prevents objective observation of the market's actual behavior. The speculator, convinced they already know what will happen, filters out or dismisses any confirming signals that contradict their fixed conviction. The market may scream a warning on the tape, but the illusion of certainty renders the speculator deaf and blind to its truth, sealing their fate. The market, in its profound indifference, has a relentless way of humbling all who claim certainty. It has no respect for reputations or past triumphs, it only responds to the present reality of supply and demand. Those who approach it with arrogance, convinced they can divine its future movements, are destined to experience its brutal lessons repeatedly, paying dearly for their hubris. The consequence of succumbing to the illusion of certainty is profound. It leads to catastrophic losses, often wiping out years of hard-won gains. It shatters confidence in one's own judgment, creating a deep psychological scar. And it perpetuates a cycle of repeated errors, ensuring that the speculator remains trapped in a prison of their own making, where the ego's demand for certainty triumphs over the market's unpredictable reality. Ultimately, humility and intellectual flexibility are paramount for survival and enduring success in the market. The market is the supreme authority. It cannot be predicted with certainty, only observed and reacted to with discipline. The disciplined speculator embraces this truth, recognizing that true mastery lies not in knowing what's next, but in mastering oneself and responding objectively to the market's unfolding story. Having meticulously dissected the insidious psychological traps that lie in wait for every speculator, the path to enduring success now becomes clear. It is a relentless, uncompromising pursuit of inner victory, forged through the cultivation of iron discipline. The market, in its profound indifference, cares nothing for your aspirations or your intellectual prowess. It merely presents opportunities and risks. Your ultimate triumph hinges entirely upon your capacity to master yourself, to relentlessly conquer the human predispositions that lead to predictable and devastating errors. This iron discipline is not an innate talent bestowed upon a select few. It is a meticulously cultivated skill, honed through conscious effort, unwavering commitment, and the repeated, often painful, lessons exacted by the market. It demands a profound level of self-awareness, an unflinching honesty in confronting one's own emotional vulnerabilities, and a systematic dismantling of their power over rational decision-making. The speculator must become their own most vigilant guardian, perpetually policing their thoughts and impulses. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. The bedrock of this discipline is an unwavering adherence to a predefined trading plan and a set of immutable rules. These rules, meticulously crafted from objective market analysis and hard-won experience, must be treated as sacred, never to be violated under any circumstance. When the market is in motion, when emotions run high, the intellect's calm foresight, embedded within these rules, must reign supreme over the impulsive demands of hope, fear, or greed. Cultivating iron discipline means embracing a profound level of emotional detachment. It is the ability to observe market movements with the cold, scientific objectivity of a surgeon, rather than the fervent hope or paralyzing fear of a gambler. This detachment allows the speculator to make decisions based solely on facts and probabilities, unclouded by personal biases, transient emotions, or the seductive whispers of the crowd, ensuring actions are always rational, never reactive. This disciplined approach fosters a consistency of action that fundamentally alters the speculator's trajectory. Instead of erratic decisions dictated by shifting moods, discipline ensures a steady, methodical execution of a proven strategy. It eliminates the destructive whipsaws of impulsive trading, minimizes unnecessary losses, and allows for the precise and confident capture of significant market moves, ensuring that effort is systematically translated into profit. The true test of discipline often occurs in the face of adversity. When a trade moves against you, when a period of losses threatens your resolve, or when the market appears chaotic, true discipline compels you to adhere to your rules, to cut losses swiftly, to wait patiently for clarity, or to remain strategically out of the market. This unwavering commitment in the face of challenge is what separates the enduring few from the vast majority who inevitably succumb to emotional despair. This internal victory over one's own psychological predispositions is the ultimate competitive advantage in the market. While others battle external conditions or chase fleeting tips, the disciplined speculator is engaged in a continuous process of self-mastery. This inner control ensures that every ounce of analytical prowess, every insight gained from market observation, is translated directly into profitable action, uncorrupted by human frailty. The psychological freedom that accompanies this discipline is profound. No longer a slave to emotional whims, the speculator operates with a clarity of purpose and a calmness under pressure that few can achieve. This liberation from the tyranny of hope, fear, and greed allows for unhindered decision-making, ensuring that every action is a conscious, deliberate step towards wealth accumulation, rather than a forced reaction to internal turmoil. Cultivating iron discipline is a continuous process, a lifelong commitment to self-refinement. It demands constant vigilance, honest self-assessment, and a willingness to learn from every mistake, however small. Each error becomes a valuable lesson, reinforcing the absolute necessity of adhering to one's rules, ensuring that the tuition paid to the market translates directly into invaluable wisdom and an unshakable inner fortitude. This disciplined approach profoundly impacts every aspect of a speculator's life, extending far beyond the trading screen. The habits of objectivity, patience, decisiveness, and self-control, meticulously honed in the demanding crucible of the market, spill over into personal and professional endeavors, transforming the individual into a more effective, more resilient, and more successful human being in all facets of existence. Ultimately, the path to inner victory requires a relentless commitment to mastering your own will. It is a journey of unwavering self-control, of subordinating immediate emotional gratification to long-term objective truth. This is the bedrock upon which all lasting market success is built, ensuring that your capital, your principles, and your very destiny remain firmly within your disciplined command. Therefore, understand this: the war against these psychological traps is relentless, but the victory, forged in the fires of your own discipline, offers the greatest reward. For when you become the master of your own mind, you become the undisputed master of your financial fate, immune to the very forces that mercilessly ruin the undisciplined. Having meticulously dissected the 8 insidious psychological traps that lie in wait for every speculator, leading countless to financial ruin, we arrive at the profound truth: mastering these psychological pitfalls is not merely a defensive strategy, it is the ultimate, insurmountable competitive advantage in the relentless arena of the market. It transforms one from a mere gambler, tossed by the whims of emotion, into a true market master, capable of wielding principles with unwavering precision and achieving consistent, formidable profitability. The mind of a master speculator is a fortress, impervious to the seductive whispers of hope, the paralyzing grip of fear, and the blinding haze of greed. It operates with a cold, unwavering objectivity, executing strategies based solely on the market's unvarnished truth, uncorrupted by personal bias or transient emotional states. This mental fortitude, forged in the crucible of countless battles both internal and external, is the most valuable asset a speculator can possess. This ultimate edge is not found in secret indicators, privileged information, or complex algorithms. It resides solely within the disciplined application of immutable psychological principles, the ruthless suppression of ego, the unwavering commitment to objective observation, the profound patience to await clarity, and the iron will to execute a predefined plan without hesitation or emotional interference. This inner mastery is the silent force behind all enduring market triumphs. The transformation from a novice, prone to the market's psychological traps, to a master speculator is a journey of relentless self-refinement. It involves meticulously identifying one's own predispositions, confronting them with unflinching honesty, and systematically dismantling their power over rational decision-making. Every psychological victory, every conquered impulse, strengthens the speculator's inner resolve and sharpens their edge. This profound self-mastery yields unprecedented clarity. The chaos of market fluctuations, the noise of external narratives, and the pressure of real-time decisions, all recede, replaced by a calm, focused understanding of underlying forces. The speculator, free from emotional turbulence, can see the market for what it truly is, a predictable environment for those who have mastered themselves. The ultimate reward for cultivating this psychological edge extends far beyond mere monetary gains. It is the acquisition of intellectual freedom, profound self-reliance, and an unshakable inner peace that transcends the external world's volatility. No longer a slave to emotional whims, the master speculator operates with a profound sense of control, their destiny forged by their own disciplined hand. This disciplined approach fosters a consistency of action that fundamentally alters the speculator's trajectory. It eliminates the erratic decisions dictated by shifting moods, minimizes unnecessary losses, and allows for the precise and confident capture of significant market moves, ensuring that effort is systematically translated into profit, thereby building a legacy of enduring success. The constant vigilance required to maintain this psychological edge is a lifelong commitment. The market, in its ceaseless testing, will perpetually probe for weakness, tempting you with new forms of hope, fear, and greed. But for the master speculator, each challenge is merely another opportunity to reinforce their discipline, to deepen their understanding, and to further solidify their unshakable mental fortitude. This internal victory ensures that every ounce of analytical prowess, every insight gained from rigorous market observation, is translated directly into profitable action, uncorrupted by human frailty. The mind, liberated from its internal shackles, becomes a formidable instrument, capable of operating with a precision and objectivity that few can achieve. The true legacy of a master speculator is not simply the millions accumulated, but the indomitable spirit forged through relentless self-mastery. It is the profound wisdom gained from overcoming one's own limitations, the resilience cultivated through confronting devastating losses, and the unwavering discipline that ensures consistent triumph in an unforgiving arena. Therefore, understand this critical truth: the battle for financial supremacy begins and ends within your own mind. The market will offer endless opportunities for profit, but only to those who have first won the war against their own psychological predispositions. This is the ultimate lesson, purchased at immense cost by those who came before, yet freely offered to those who possess the wisdom to listen and the courage to act. This is your blueprint for enduring success. By diligently identifying and systematically dismantling these psychological traps, you will unlock your ultimate edge, transforming yourself from a mere participant into a true commander of your financial destiny. The path to becoming a professional speculator begins and ends with the mastery of yourself.